Hi, investors. It's Nick Garner here from InvestMore, and today we're going to do a fairly deep dive into some data. Uh, Really, just to summarize, what I want to talk about is that I'm getting increasingly anxious about an impending property crash. I don't think it's going to happen for at least 3 or 4 years. There's such a thing as the 18-year property cycle. So I'm going to talk you through that and then talk you through some data I've pulled together, which just shows which areas have done well through that crash and which haven't. And then I'm going to show you the map version of this. And then I'll go into what we're doing about this because obviously it's useful information. And I think it's going to influence a lot of investment decisions that I make and that I advise my clients to make. All right, so let's get into it. Now, the first thing I've got here is MSOA data. Now, if you're not familiar with MSOAs, they are areas with about 5 to 10,000 people typically, and there are 7,201 of them in the country. And they're used by the government to the UK government for census purposes. So they record house prices, demographics. Um, yeah, I mean, house prices and demographics are the main things that they record here. But the good thing about this data is that it's small enough to be quite granular, as in we all know that property is a hyper local thing, but big enough so that the data that I'm getting isn't too messy. In other words, when you look at, say, average house prices or median house prices, which is what I'm interested in, uh, the the data sets are big enough so that the data is fairly consistent and therefore it's actually useful. So what we're looking at here is a pivot table in Excel where I've looked at the difference between property prices from the peak of the market, which was 2008, to the bottom of the market at 2013. Now, to give you context, if we quickly look at this, we know that property goes in cycles and it goes up and it goes down and up and down and up and down. And it's a typically it's an 18-year cycle. And I've written a whole article about this. And we can see here, for example, here's a breakdown of the market going up and down, and now it's going up through another cycle. Here's another example of market cycles, and it's pretty repetitive. And for example, here, I've even bookmarked this because I talk about it so often. This is property cycles going way back to 1845. This shows house price affordability. So as affordability gets worse, you get a little spike. So this would be 12 times your monthly or annual salary. In fact, it is. So it's 12 times annual salary to buy a house back in 1845. In And you can see here very regular cycles where affordability, whilst it's getting better for people, you still get these little peaks. It was disturbed by the First World War, and then then we saw the Second World War, but then just after the war, which is very analogous to the time we're now in, by the way, which is high government debt, a global threat. Back then, it was Japan and the Nazis. Um, Today, it's COVID, but it's the same old story. It's there's a threat. There's a lot of government debt around, and the 1940s was, of course, a decade of inflation, and I think we're likely to see something similar here. But anyway, there was a massive spike. And what's curious about this is you would say, well, surely loads of people died in the war, and therefore there'd be less demand on property. Well, you would think that, wouldn't you? But when you have a lot of inflation, you've got people diving into assets. And I think we're seeing a lot of that now. And then, of course, we have another spike, another spike, another spike. And this is 2007. And in this chart, we're probably around here now, which means that property in affordability terms was about the same as it was back in 1890. I'd go all the way back to 1881 or 82, that kind of period. Crazy times. So the 18-year property cycle is a very real thing. And one of the things that I've been looking into is how to stay out of trouble in the next property crash. And with that in mind, what I've done is I've taken this data, this MSOA data, which I really like. It's very reliable. It's just very consistent, useful information. And it looks at the median price. So a median price, I'll highlight something here. Let's say we've got 12 of something. The median would be the midway point. It would be the midpoint number. And this is really useful for property because it means that you don't have outliers. Because in an area, there might be a block of flats and the whole block might be sold. And since annually in a given area, MSOA, you typically get like 12, 15 transactions a month. I mean, a year, should I say. So it's not that many transactions, and therefore averages are very prone to just error, let's say, or skewing, as the term is used. Okay, so let's just talk about what we have here. This is the decline, the market decline, inflation adjusted. Now, just to explain what I've done here with this data, it's very easy to forget about inflation, but actually it's a critical variable. So from the start of my data set, which is 1997, essentially inflation has halved the value of money. Or in other words, if, for example, I bought a property in 2001 or 2021 and I spent, say, £100,000 on that, then the equivalent purchasing power way back in 1997 would be about £105,000 back then. So in other words, that £105,000 could buy me so much stuff, and in 2021 I need to double the figure. Now that's based on the consumer price index. There are lots of other measures of inflation, but the CPI is the most widely recognized, and therefore that's the one I'm using. And so what I've done is I've adjusted house prices based on inflation over time. And therefore I've used a multiple, for example, for 2008 of 1.41 in my numbers. So therefore I multiply the house price back then by 1.41. Because that gives me an equivalent purchasing power number that I can work with, and therefore all the data makes a lot more sense, which is important because the data gets very complicated otherwise. Anyway, we have a local authorities pivot table here, and there's a very clear correlation between social grade and how much the market declined. So in Blackpool, which is notable because it is the most deprived area in the country, property prices crashed by 35% from the peak of 2008. So in other words, somebody owns a property there, it crashed, their wealth would have been, a third of their wealth would have gone. But then you have other areas, like in London, for example, where, for example, Richmond, that actually rose in real terms, inflation-adjusted terms, and the biggest winner was Kensington and Chelsea. So, and these areas had the highest demographics. And so I've done a little correlation analysis here. It's a very simple one, but it reveals a lot. And what it says is that on the run-up to the last market spike. So I've used 2007 here. It could be 2008. I mean, there wasn't much difference. But broadly, on the run up in the last leg of the last property cycle, the highest social grade areas, i.e., the areas with the richest people, had the lowest correlation with capital growth. In other words, they didn't grow that much. And then the areas with the richest people on the way down, i.e., the market crashing, actually did the best. They correlated with the least decline in value. And the inverse is true in the lower social grades. So that's a national view. But then, in order to get a bit more granular with this, what I decided to do was get MSOA for local authorities. So again, really useful because it's granular and I can look at it at local authority levels. So one of my favorite areas is Manchester. So we'll pick a few areas and then what we'll do is we'll look at the mapping and maybe flip between the two. I don't know, we'll find out. But here is Manchester, and there we go. And what you see here is a very similar kind of correlation. So on the way up, the good areas didn't do so. On the way up, the good areas didn't do so well. They did okay. And on the way down, they did very well. In other words, they preserved capital much better. And we can see this if I look at the areas with the least decline. I'll go smallest to largest. So we can see here that it's these kind of higher value areas where the median house price is like, this is today's median house price, by the way, March 2021. And you can see that these areas actually suffered the least decline. But you can also see that the cheaper areas, inverted commas, suffered a greater decline. And then you can also see, if I zoom out a little bit, just so you can kind of see some kind of trend, we can see here, I'll just make that with social grade AB, generally speaking, the areas that did the better have higher proportions of social grade AB. So it's a very clear pattern. It's pretty obvious, but sometimes people kind of live in hope and they go, well, everything's going to be great. I'll buy wherever I can. It'll be fine. And the reality is that that's not going to be the case. And so when one looks at capital decline, it's not just looking at one area over another. It's also looking at a whole city. And oddly enough, in the last crash, Manchester did quite badly. And I'll just show you here, it's easier. So where's Manchester? There we go. And on average, it declined 28% for that. Now, there's also in Manchester, we also have Stockport. So let's just see what Stockport did. And peak Stockport, LMNOPQRS. Where's Stockport? Maybe that's, I can't remember what the name of that local council is. I'm sure it was Stockport. Maybe it's not. All right, whatever. I'm not going to dwell upon this, but we'll see some of these numbers on the maps anyway. My main point is that they're very consistent patterns and they're consistent with every city. So you can see here, again, the same kind of story. Now, what's interesting about Liverpool, though, is that the difference, there was very little real capital growth difference between the expensive areas and the poor areas, but there was a huge difference on the way down. And you can see this here. So we can generally see that the higher priced areas, the higher priced medians, did better on the way down. And if we look at, I'm going to show you just Blackpool because I think it's a very good example city, just showing sadly the worst of the worst. And we can see here that in some areas, growth declined by nearly 50%, which is horrific. And what's interesting about this area is that because the average social grade in Blackpool is so low, that anyone who was basically C1, i.e., they had a job that and they could live and get a mortgage, their capital growth declined far less, but overall the city declined very heavily. So that's that, and it just a lot of this data. If you're interested, I can share it with you. But let's have a look at some of the maps. Now, this is so the way this works is that I've put all this data, organized it, and put it into something called Elasticsearch, which is a platform we use, and it is very good for visualizing information. And because property is a very localized thing, just looking at stuff on a map really helps with understanding what's going on. So we're going to pick the main northern cities and just quickly talk about each story as we go through. Now, the first cycle I'm going to go into is decline, because that's the theme of this. Like, what do you do in capital decline? And we can see with Liverpool, for example, there are very clear patterns, which are that areas outside of the main city did better, relatively speaking. Now, that's one way of looking at it. And the other way is just, well, how's it done in the short term? Well, let's find out. So this is March 2018 to March 24 to March. So 3 years of growth. And again, inflation adjusted. And you can see that there are lots of interesting little spikes here. That's fine. I think they're anomalous, and therefore I'm more interested in the overall story and the pattern. And the pattern I'm seeing is that areas which did better on the way down, i.e. these kind of outskirt areas, these kind of places, these ones are generally slightly higher social grade, slightly more expensive, but are more resilient and actually show capital growth. So this is the inflation adjusted number. So 15% in the last 3 years, which is very strong. But not all areas have done that. So again, I'll just flip between this, and we're now seeing the 3-year story. And you can see that there's a strong argument for diving into, say, more deprived areas. But history shows us that if one does that, that's fine for now. But those areas are prone to catastrophic capital decline. Now, the only way you can get around that problem is if you buy early enough, and I'll just make it bigger so you can see it. If you buy early enough and then you wait it out, and you just hang on in there, and then the market declines. And if you bought here and the market, let's say for the sake of discussion, you bought here and the market declines to here, well, you're still above water. That's okay. What's not clever is getting greedy, buying at the very end of the cycle, and then you suffer a 20-30% loss in capital or in asset value, and then you got the banks chasing you, looking for more deposit, and that would be catastrophic. So there's this whole thing about getting your gearing right, picking areas which can take a knock, and then buying wisely, and actually in this cycle buying as soon as you possibly can, in fact, because the sooner you buy in the right area with good capital growth, the safer you'll be. So, okay, that's Liverpool, and basically the pattern is looking at areas further out. So I'm just going to pick on this area for a moment just to show you some of the data. And this gets very granular, so I'm not going to go into it in any real depth, but I just want you to understand roughly how we analyze stuff at a super detailed level. And for example, here we've got some social housing. Now, I've never looked at this patch, so let's just see what it actually has. And we can see here that there is some kind of, yes, there's a council estate there. So when we analyze property, we go right down, right down, because you actually have to. And we can see there's a lot of crime in this area, unsurprising and very sad. And then we can zoom out. So the point being that we're lucky enough to be able to look at stuff from very high level and then zoom down into low level. And broadly speaking, there are these little patches which work. And that's encouraging. Work on the way up, work on the way down. So the next area I want to look at is Manchester. And you can see here again, if we look at the long-term decline story, as it were, it's the same story where you have very high social grade areas like this one here. And I know that they're I'm pretty sure they are high social grade generally. Let's zoom in and have a quick look. And I'll just do it at that level. That should come up. Yeah, it's under load, as it were. And you can see, so this means that this number 81, what that represents is 81% of the population are social grade AB C1, C2, not DE. And the way it works with areas are they don't change very much. So even though this is 2011 census data, the fact is it's good data and it's still relevant because guess what? Areas don't change much. People change in areas. Yeah, I know. That's how that works. So therefore, this makes our data really reliable. And this is an interesting area. So, for example, if one could find property at a sensible price in an area like this, I would be interested. Now, one of the issues is it's not cheap. So therefore, we have to look elsewhere. And generally, what I'm doing at the moment is looking much more at other cities, actually, because I, as much as I think Manchester is great, and it is, what I'm afraid of with Manchester is resorting to advising our clients to buy junk property, which would just fall like a stone in a crash. And we cannot do that. So we're just not going to do that, full stop. But there are areas like Droylsden, which are a little bit hot, but certainly areas outside of the Manchester ring motorway. But let's just have a quick look at the short story, the 5-year story with Manchester. And we can see here that there are lots of areas which have done incredibly well. Like it is a hot city when it comes to capital growth. And that's fine. But there comes a time when enough is enough. And I think there's still quite a lot of headroom in Manchester. But the catch with buy to let is that if you start spending more than £200,000 on a property, yields get very thin, and therefore it's not cash generative, and you're just relying on capital growth. It's quite a risky place to be. So I generally think it's better to at least achieve 5.2% yield. Then you can gear up and get some net cash return on your money. Now, this is Sheffield. And Sheffield isn't quite as hot and hasn't done quite as well. Now, there is one thing I forgot to show you, which is this. This is really useful data from property data, and it's turnover on rent and sale. So I'm going to, in fact, I'm just going to go back to Liverpool for a minute and show you this. So I said that this area was interesting. Let's see what's going on here. It's very hot. So 132% of rental stock put on the market is sold. In other words, or is rented out. In other words, properties will rent in 2 weeks. And we can see that the turnover of sale, 30% of properties put on the market are sold each month. It's really hot around here, but the long and the short term data validates that it works. So what we're looking for are areas where there's a very brisk market, a healthy sales turnover, strong rental demand, and robustness and yield. And yes, it's a lot of things to ask for, but then we're lucky we have this system, we can do these things. So I'll just hide that for now. And let's just quickly look at Leeds, and let's go back to Sheffield because we started talking about it. So, all right, I'll go back to the 2008 to 13 story, and you can see lots of areas got absolutely crushed, like 42% decline, 40% decline. And these kind of areas are probably very poor. Again, it's yes, they are. So I can tell. It's very easy to tell by the way you just look at the numbers. If the numbers are below 40, it's poor and deprived. And sadly, this is a very deprived area, and that explains the number. And again, I go back to my point that when people are going up the final ramp on the last leg of the cycle, they get desperate. They buy anything, and that's what happened. And we can see here, back in 2008, the median price was 141,000, and now today, and this is inflation adjusted, by the way, and today, inflation adjusted, it's is that right? Yes. So that would be median price. Sorry, where am I? Yeah, that's right. So that would be. Okay, I'm back. Sorry about that. I just thought I saw some numbers not making sense, and I've had a look through them, and they do make sense. So I'll just explain. Got the 2008 inflation adjusted number 138,000, and it dropped all the way inflation adjusted down to 80,000. That's a decline of 42%. So imagine you're on the wrong side of that. Not pretty. Now, one of the things that you'll see, though, is that it's the outer areas, these kind of suburban, three-bedroom, semi-detached suburban areas that always seem to do quite well on when the market is under stress, because these are employed people and so on. And one of the other interesting things is that in the last few years, you can see here that that actually they've had the best capital growth. So again, it's like these areas work, they're safe. And for example, here we can see the median house price for this little patch, which was good on the up, good on the down, and that's £103,000 median house price. So that would include apartments and so on. I do have some new data which I'm putting in, which also lists houses and semi-terraced houses and so on. But as a general indicator, this shows you it's like the areas outside city centre generally do best. And this is house price inflation from 2013 to date in Sheffield. Again, it's these outer areas which do very well. So the next area I want to look at is Leeds. Let's just have a quick look at Leeds, and then we'll have a quick look at London, and then we'll stop it there. Okay, Leeds is interesting because it has what I call a lot of cultural fragmentation, which is sad, really. But you know, it is what it is. So just to explain, from from 2013 to date, this area has declined in real terms in a big way. Lots of areas within Leeds have gone up, so that's fine. If we look at the short-term picture, like is the growth still strong? And the answer is here, no. Here, yes, to some degree. But how would it deal on with a crash? How would it deal on the way down? And the answer is if it's town centre, badly is the answer. And this is even more so, I think, today than it was 15 years ago, because we have an awful lot more city centre high rise. We've got problems with cladding, a lot of these properties. And generally speaking, I would say a lot more people are working from home. And the kind of people that live in lifestyle apartments are the ones that don't live, that have chosen to live further out. So in the long term, it's these surrounding areas that work in the and in long short term and in a downturn. Now, the exception to the whole pattern. And by the way, this pattern is pretty much everywhere. Uh, but one thing that's very interesting about London is how it defies the crash. And I'll show you here. So we go from 2008 to 2013, and we can see huge areas in London actually going up in value in real terms, and the outer areas going down in real terms. Now, the question is, why was that? And I would say it's because of international money. There was a period where stamp duty was relatively low, sterling was low, and wealthy people saw London as a good, safe place to store wealth in bad times. And so there was a lot of competition. Property prices went up, and here we are now. So, so London is that exception. But the interesting thing about London is that if you look at the prices since 2013, then we can see that central London has essentially stalled, but the but there's been this kind of radiating effect where prices further out have gone up. The issue with London is that the average property price is far too high to make it viable for internationals to do buy to let because the interest rates are too expensive. So London is kind of a no-go zone. Arguably, if you're looking at buy to let anywhere from, say, I'll make this a little bit smaller. In fact, what I'll do is I'll just turn these off. No, I'll go to Google Maps. It's easier. Anywhere from really Northampton upwards is viable for buy to let. And our general strategy is to concentrate on bigger towns, avoid bigger towns that are satellites to, or smaller towns as well that are satellites to bigger towns. But what doesn't work is where you have a small town in the middle of nowhere. So Ordsall, for example, or somewhere like that. It's got to be within the catchment of a bigger city. And as I say, we're looking north, and there are certain demographics we always look for. And as you see now, we're looking out for those areas which are robust on the downturn as well as the upturn. Anyway, so to summarize all of this, higher in the market upswing, cheaper areas do better on capital growth, i.e. lower demographic areas where there's cheaper property and so on. But that's because money, the better areas have basically got saturated and they've grown enough, as it were, and they're not going to grow anymore because they become unaffordable. And therefore money displaces out to these lower value areas. The catch with those are that they are, from an investment point of view, they're populated by people who have more precarious incomes. In other words, they just can't earn money as reliably as ABs or doctors and scientists and doctors and whatever. So that's the pattern that we're seeing. And then you have a macro level, which is that cities have patterns and long-term capital growth and decline. And so places like Liverpool, Newcastle, Blackpool, Blackburn, Bradford, Preston, those kind of towns and cities, long term, they've declined. And for me as an investor, I avoid them because I just don't think they're viable. And beyond that, then we have other places like Manchester, Sheffield, Leeds, Nottingham, and so on. And also places like Plymouth down in the south. They work as well. Anyway, I think my main advice is just stay pragmatic. Watch the downside. You invest wisely and safely, and I think you'll get, you'll be okay, as it were. Anyway, I hope that's helpful, and thank you very much.